Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Ondas.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Yeah, let's do it.
For anyone tracking the specialized world of autonomous systems, Ondas just made a massive amount of noise.
They really did.
We are looking at a company that hit a huge financial inflection point in the third quarter of 2025.
And the headline number was just impossible to ignore. $10.1 million in revenue.
Right, but even that number doesn't quite tell the whole story.
No, it doesn't. 10 million is a solid number, sure, but that doesn't capture the shockwave it sent through the market. When you look deeper, you realize this isn't just a successful quarter.
It's a new dimension for the company.
Exactly.
That 10.1 million, which was driven mainly by deliveries of their Iron Drone and Optimus systems, represents a 582% increase year over year.
582%.
That is what we call a step change in scale. This isn't gradual growth.
No, it's a near vertical acceleration. And the market was clearly caught off guard.
Completely.
Analysts had penciled in revenue around, what, $7 million? Maybe a little more?
And they beat that consensus by a massive 41%.
When you surprise the market by that much on the top line, you force everyone to just rethink their entire model for the company's future.
And that surprise was the cue for management to get aggressive.
They didn't just sit on it.
Not at all. They didn't just bask in the Q3 glory. They immediately projected that momentum forward. They lifted their full year 2025 revenue target to at least $36 million.
Which is a big jump from their prior target of $25 million.
A huge jump.
But $36 million is great, but the number that really makes this a high-octane growth story is their preliminary target for 2026.
It is the critical number. They issued a preliminary 2026 target of at least $110 million.
$110 million.
So if you, the listener, are looking for a high-risk, high-reward growth play, that number, that $110 million, is the entire thesis.
It implies the business could more than triple in size.
Again, next year.
That's the kind of jump that can turn a small-cap niche player into, well, a dominant force in the sector.
And we're starting to see the first signs of operational efficiency, which is vital.
Right, because growth without profit is just expensive.
Exactly. So we saw gross profit jump from basically nothing last year, $500,000, to $2.6 million this quarter.
And the margin is the key thing there.
It is. The gross margin expanded significantly, moving from 3% all the way up to 26%.
Wow.
That margin expansion is probably the most bullish sign hidden in these results. It signals that as they ramp up volume,
selling more Iron Drones,
you're gaining operating leverage, absorbing their fixed costs faster. It's the first step on the path to profitability.
But this entire explosive growth story, it needs something massive to fuel it. It needs cash.
That's the perfect transition.
Yeah.
Because if the growth is the engine, the balance sheet is the giant fuel tank.
And it allows them to run at full speed for years.
This company is exceptionally well capitalized.
Yeah.
They ended Q3 2025 with $433.4 million in cash and equivalents.
A massive financial war chest.
And we have to use the term pro forma here, which just means we're looking at the total picture after their latest moves.
Oh, after the quarter ended.
Right. They did a big equity raise in October, netting around $407 million. So you add that to what they had, and their total cash position balloons to approximately $840.4 million.
Okay, stop and think about that for a second. For a company in this very specialized autonomous systems space,
It's almost unheard of.
it means they're not just swimming in cash, they've practically bought a defensive island.
It guarantees survival. And we can see this stability in their financial indicators, too. They have a very high current ratio, sitting around 15.3.
Now, for listeners who aren't CPAs, what does a current ratio of 15.3 actually tell us? What's the takeaway?
It tells you they have virtually zero near-term liquidity constraints.
So, no trouble paying the bills?
None. The ratio measures their ability to cover short-term liabilities. Most healthy companies are happy with a 2 or a 3.
And they're at 15.3.
It confirms they can confidently fund everything, their aggressive organic growth, integrating all their acquisitions, without relying on debt. They are fully self-sufficient right now.
And that huge pile of cash is actually working for them while they spend it.
It is. While they are still operating at a loss, they reported $2 million in interest and dividend income.
Okay.
and another $6.9 million in unrealized gains on their investments.
So that's almost $9 million in non-operating income.
Right. And it provides a significant, pretty sophisticated buffer against their current operating losses.
And all that money, that massive war chest, it isn't just sitting idle.
Not at all. It's allowing them to aggressively pursue their main strategic goal, which is building an impenetrable competitive moat through M&A.
They're not just a drone company anymore.
No. They're assembling a core plus strategic autonomous systems platform anchored by their traditional OAS business.
So this is the core idea. Use cash to buy capability and lock in your customer base. What exactly are they buying?
The focus is highly strategic. They're creating a portfolio that includes defense-grade autonomous systems, specialized counter-drone tech, and high-end motion technologies.
So they're buying companies like Centrix and Rift Dynamics.
Exactly. Centrix gives them cutting-edge counter-UAS software. Rift Dynamics brings advanced motion control. This isn't about buying quick, low-margin revenue.
It's about buying unique, defensible IP.
That's it. IP that solidifies their position in defense and critical infrastructure.
So they're buying the pieces to build one single integrated platform. But how does that actually stop competition? Where's the moat?
The integrated portfolio creates what analysts call multi-domain switching costs.
Okay.
This is where the cash really pays off. Think about a major defense customer or maybe a critical infrastructure operator like an energy pipeline.
Right.
Once they standardize their entire operation, the hardware, the software, the certifications, the staff training, on the single comprehensive Ondas stack.
It becomes a huge headache to leave.
Exactly. Vendor replacement becomes extraordinarily difficult and expensive.
It sounds a bit like the Apple ecosystem. Once you're all in, it's just too much hassle and cost to switch.
That's a perfect analogy. The costs aren't just financial. They involve high regulatory qualification, new certifications for people, new training programs.
So those switching costs are the real barrier to entry for smaller competitors.
A massive one.
And that regulatory angle really underlines why having $840 million matters so much in this sector.
It does. Defense procurements are incredibly long and rigorous. Platform certifications can take years.
A smaller company could go under during that cycle.
And that's the point. That long cycle acts as a regulatory and relationship moat. A smaller robotics company is inherently risky to a large government partner.
But a company with this kind of cash buffer guarantees survivability.
They
So their operating cash flow is still negative. They're burning cash.
They need that massive cash pile just to keep the lights on and keep growing.
So the core of the bear case, and the critical question for the listener is, can management actually execute?
That's it.
The entire investment thesis rests on turning a collection of expensive assets into a seamless, efficient platform that can hit that $110 million target.
It hinges entirely on execution. Integrating multiple highly technical acquisitions is historically very, very difficult.
Right.
It's hard enough merging two companies' accounting systems, let alone stitching together Centrix software with Rift Dynamics hardware and making it all play nicely under the Ondas umbrella.
And cutting costs while you do it.
Exactly. There is no near-term profitability guidance, so you are betting heavily on management's ability to pull this off without huge cost overruns or delays.
That sounds like a serious execution risk. If the integration fails, they could burn through that cash pretty quickly.
They could.
How long does that $840 million runway actually buy them?
It buys them years, plural, not months. And that is the key mitigating factor that separates this high-risk scenario from a true danger zone.
So they have time.
They have an unusually long time, maybe 2 to 3 years, to absorb those losses while they build scale and mature the integration. That cash cushion is their ultimate safety net.
So the key metric to track isn't the total loss, but that improved gross margin we talked about earlier.
Precisely. That jump from 3% to 26% is what you need to watch. If that margin keeps expanding towards, say, 35 or 40% as revenue ramps up,
Then the risk profile improves significantly.
because it proves they're finding those efficiencies. But if the margin stagnates or drops, that's your first serious warning sign.
Moving to the market action, the stock reacted exactly as you'd expect to a massive beat.
It did. A robust jump right after the Q3 report, kicking off a strong momentum phase.
Including that sharp 24.6% leap in November.
That momentum phase, however, was quickly followed by heavy consolidation and profit-taking.
Yeah, we've seen headlines since then questioning if the stock is soaring or sinking.
Right, because investors are quick to cash in after a massive run. This just underscores the intense volatility in this name. If you're considering this investment, you have to be prepared for sharp pullbacks.
This is not a smooth ride.
Not at all.
So, for the listener watching this company, where should their focus be now? What's the next big test?
The next major catalyst will be the Q4 2025 earnings report. We'll probably get that in February 2026.
And the market will be looking for what, specifically?
Two non-negotiable data points. First, confirmation that they actually hit that full-year $36 million target.
Check.
And second, any concrete update or affirmation of that ambitious 2026 $110 million preliminary target. If they reiterate, or even better, raise that number, the stock will move.
And are there any events between now and February that could move the needle, or is it just a waiting game?
No, there are definitely intermediate catalysts to track. We need to watch for news flow on specific contract wins, especially large multi-year ones.
Okay.
Updates on their growing backlog will also be critical. And look for partnership expansions, particularly around integrating technologies like Rift Dynamics.
So keep an eye on the news.
Definitely. All of these things reinforce the strong macro tailwind that supports the stock, which is just increased global defense and public safety spending on this kind of tech.
So when you connect all these dots,
Ondas presents a very clear, asymmetric opportunity for the right type of investor.
asymmetric meaning.
You have truly massive potential upside, driven by high growth targets and that incredibly strong balance sheet. But that potential is entirely balanced against this significant execution risk of integrating all these complex M&A targets.
It sounds like this is not a stock for day traders or someone looking for a quick quarterly bump.
No.
This is a multi-year growth story that requires patience and a deep willingness to, well, underwrite management's very aggressive, high-risk vision.
That's absolutely right. And this raises an important question for you, the investor. Are you willing to commit to a 2 to 4 year horizon to see if the moat holds and if that $110 million target materializes? Because if it does, the reward will more than justify the current volatility and the patience required.
A great provocative thought to end on. If you found our analysis useful today, please consider subscribing and tuning in next time for more focused analysis.